Hey everybody, this is Jim Hiles. It's Wealth Wednesday, and we're going to be looking at a long-term view of things. So let's go ahead and jump into it. Let's take a look at the investing landscape, which we think is at a relative crossroads right now. The tailwinds that we've been experiencing really from the last 20 to 40 years have been fading. It's not necessarily because of COVID, but this may be another catalyst that we'll see here in terms of how we look at the future from an expectation standpoint. Let me give an idea for what I mean here. The chart on the left, decline in peak earners has kind of rolled over. It went very steep here, more than 45-degree angle. It's really since 1980. We've had this pause and actually a rollover decline in number of earners as a percentage of working age populations. You can look at the United States, but you can also look at what's going on in other parts of the world, certainly in Japan, certainly in China, the one-child policy, and you'll see in some places in Europe as well. So a significant change here in terms of the peak earners, which generally drive markets and market prices. So something from a simple supply and demand standpoint you've got to look at. The globalization trade, which has really helped the United States globalize their economies, is really kind of flattened out. We had significant growth through the 1990s, but we kind of leveled out here in the 2010s and in the 2020. We haven't seemed to get over the 60% number as a percentage of GDP, and we may not. So globalization taking a pause here. We certainly would like to see growth, and there is opportunity out there for growth in other places like Africa and India and even China and some other places in the Latin American countries that have opportunity, but kind of a pause here. Obviously, we have some issues in terms of headwinds, debt being one of those. The percentage of debt as a percentage of GDP, I mean, this is a significant issue now and rising quickly. This is a headwind we're going to have to deal with. We're not going to be able to grow at the same rate if you've got to pay debt at these levels. On the other hand, bond yields have been low, making it relatively easy to pay for debt, but we could see a squeeze if rates change. So interesting little play here in the bond yield in the interest rate environment. But you also see from an investor standpoint, this is going back really since a little before the last 20 years, we've had a decline in the yield. Well, from a business standpoint, from an investment standpoint, two different things going on. Great that yields are going down, you can borrow money cheaply. However, from an investment standpoint, I'm not able to make the same yield I used to get or expect when I did my original planning for my retirement. Matter of fact, if we're 10-year treasuries at 1.3, 1.4, whatever they are today, you have to think about that for a second. After taxes and inflation, you're basically a negative yield. And from an investment standpoint, that could be a potential problem. The other thing you have here is if rates were high and have coming down, you actually probably saw some appreciation in your bond portfolio, which helped supplement the returns of those bonds. And we don't really expect to see that going forward with rates continuing below where they are today. But one of the things to point out is when you look at investing in the time of COVID, we've had this recovery and we've had this crazy amount of stimulus, but a lot of the easy gains, let's put it that way, have been had. And there are still opportunities here regarding this uncertain premium that's available, meaning things are less valuable because of COVID than perhaps they will be if COVID weren't here. So that creates opportunity to invest at a lower value, which is good as the economy improves and things broaden out to get out of this COVID situation, which you think we're going to do. But it's going to be harder, and you're going to have to look more selectively. You have to look specifically at things like credit and even some selective stocks or equities in the market rather than just buying just across the indices, benchmarks, things like that. But you have to kind of look at investing after COVID from a projection standpoint. In other words, we're trying to project out, investing for the future. And what we're likely to see going forward is a lower return for a while. And obviously the bond yields, as I just said, are low and we're likely to stay low for longer when you look at what basically the Fed notes said most recently. But you're also looking at the 60-40 portfolio. 40% of that was in bonds, which gave you some appreciation. So that's not going to be there. And we're in a low interest rate environment. So you're not going to pick up the great return on that bond portfolio. You've got to do something else. And what we think the something else is going to be will be in things like alternative investments, which don't behave like a stock or like a bond per se. But if you're not willing to take those kinds of changes in stride in your portfolio, then you might just have to deal with what could be a low return amount of time or performance going forward from here. So just a heads up as you start thinking about where we are. Of course, we're trying to do whatever we can to make the performance from a risk-adjusted standpoint as high as we can. That's our job. On the other hand, there's some expectations which go hand in hand with where things may actually turn out. So Jim Heil signing off for now on Wealth Wednesday. We'll talk to you soon.